forward market. These markets are opposite to spot markets. In these markets, the currency or these markets deal with the exchanges which are related to future or the delivery in future. We call such kind of markets as exchange markets. One second. Yes. Whenever we are talking about yes. Whenever we are talking about forward markets are completely opposite of spot markets, in the sense the dealings will not happen on the spot, or the currency will not be exchanged on the same day. They will be carried forward in the future, or they will be delivered in the future. That's the reason they are called as forward markets or derivative markets. Now, they are also called as forward exchange markets because future and forward transactions are performed. If you are performing immediate transactions, we call it as a spot market. Now, whenever we are talking about this foreign exchange currency, the supply and demand, whether it is spot market or whether it is future market, for any specific currency, right, is determined by its exchange rate at that specific point. See, today, even if you are even if you want to exchange your currency today on the spot, even if you want to exchange your currency in the forward market, that is derivative markets, at a future point of time, the currency is exchanged only at the rate at which that happens at that specific point of time. Now, whenever we are talking about foreign exchange currency, the major features of foreign exchange currency is, see, this forex market is the largest market in the world because it is one of the oldest market. One or the other country is dependent upon the other country for their foreign currencies, so it is considered to be one of the world's largest market. And most of the foreign exchange market is over the counter market. That is, they don't have a single location. They are physical or electronic, or a centralized exchange like a stock exchange is not present in forex market. And third thing is, it operates round the clock because it is not one country where you can take one time zone into consideration, because it operates throughout the world, because it operates throughout the globe. They have different time zones, so they work 24 by 7, oh sorry, 24 hours in a day, only except weekends. Every day they work. Now, whenever we are talking about the foreign markets, right, they are like worldwide connectivity of interbank traders. That is, all the banks across the world are connected by computers and telephone line in order to facilitate the exchange of currency, or in order to facilitate the trading of foreign currencies. These predominant banks are connected by computers or telephones. One of the greatest feature with this forex market is they are tremendously volatile. That is, they are subject to very frequent changes. They are subject to changes very quickly, right? That's the reason they are considered to be the most volatile markets. Not only that, the volatility of these markets are influenced by the demand and supply. What is the demand for that currency, right? And what is the supply of that currency? These two things influence the scale or the intensity with which the participants participate in this foreign exchange market. And not only that, the foreign exchange market is completely categorized by high volume of transactions. That is, over the years, we have seen increase in the volume of financial transactions. Therefore, they are highly categorized with the volume of transactions. Not only that, one of the important feature with this foreign exchange markets is they take into consideration low trading cost. A minimum fee is charged towards commission, whereas in other markets the fee is very nominally high. But when it comes to foreign exchange market, the commission that they get for the commission that the dealers get, or the commissions that the dealers charge for such exchange, is usually low when you compare it with the other markets. Now, one thing that we need to learn in foreign exchange market is there is something called as a quote, right, which is mentioned in the foreign exchange instruments that we need to learn about. See, whenever we are talking about quote, the quote is the exchange rate. See, whenever you want to exchange one foreign currency with another foreign currency, or whenever you want to exchange your currency with any of the foreign currency, there is something called as an exchange rate, which an authorized dealer is ready to deal, right, with respect to that specific currency. See, we have a lot of currencies, like we have Indian rupees, we have dollars, we have pounds, we have euros. So whenever you want to deal with a specific currency, that is, you want to convert Indian rupees into dollars or Indian rupees into pounds, there is an authorized dealer who is ready to deal, right, that pair of currency, that is between rupees and dollars. He is ready to deal, and he is ready to exchange it at a specific rate. That specific rate is called as a quote, right? The foreign exchange quote indicates the number of base currency units that must be paid in order to obtain the quoted currency. See, whenever you want to exchange a currency, right, it is measured, or it is quoted, uh, it is quoted based upon the number of base currencies. See, for example, 72 rupees 0.689, right, is $1 base currency. Now here, rupee is the base currency. It is quoted first here. The second quote currency is the dollar. So whenever you want to obtain $1 is equals to 72 rupees 0.689 rupees. So it is always quoted with that base currency. Now, whenever we are talking about quotes, there are two types of quotes. One is direct quote and the second one is indirect quote. Now, a direct quote, whenever you are talking about a direct quote, see, for example, the base currency is your domestic currency and quote currency is foreign currency. So, whenever you are talking about a direct quote is an exchange rate, right, which expresses the domestic currency in terms of single unit of foreign currency. See, for example, $1 is equals to 72 rupees. For single unit of foreign currency, how are you expressing your domestic currency? That is called as direct quote. Direct quote is always expressed in number of home currency units per single unit of foreign currency. I told you 72 rupees per $1. $1 is foreign currency, that is single unit, whereas 72 rupees is your home currency. 72 units is the home currency. So how are you expressing your domestic currency in terms of foreign currency? That is called as direct quote. Whereas whenever you're talking about an indirect quote is a quote in which foreign currency is expressed as a single unit of domestic currency. For example, 1 rupee is equals to how much of foreign currency? When you are putting domestic currency, right, units into single currency or foreign unit, we call it as direct quote. When you are using single unit of domestic currency with the units of foreign currency, we call it as an indirect quote. Now, in direct quote, in direct quote, the base currency is domestic currency, whereas in indirect quote, the base currency is foreign currency. Now, whenever we are talking about foreign exchange markets, these foreign exchange markets have certain functions. What are the functions of foreign exchange markets? Is the first function that they do is they have the transfer of purchasing power. That is, these foreign exchange markets helps in fund transfer, that is foreign currency from one country to another country for settlement of payments. To put it into simple terms, they help you in converting one currency into another, right? They help in transferring the purchasing power of one country to another country. See, for example, if USA is exporting uh, India, the payment has to be done in rupees, right? Then here dollars are converted into rupees by the foreign exchange market. So they give you that, they help you in converting foreign currency into your own domestic currency, or they help you in converting your own domestic currency into foreign currency. Not only that, they help you in international clearing function. See, in order to facilitate capital or in order to facilitate international trade, the role of foreign exchange markets is very, very important. So international clearing, if you have any settlements, this, or if you have any payments, this foreign exchange markets will help you out in clearing those functions. Not only that, They help you in provision of credit, right? See, whenever you are entering into an international trade, right? Any company might want to purchase certain things in another country, right? But their terms and conditions are completely different. So this forex market will provide credit facilities for both exporters and importers whenever there is a credit that is required. So in order to make sure that international trade happens between two countries in a smooth manner, or in order to make sure that countries enter into international trade by importing and exporting, whatever credit is required by any country, this foreign exchange markets will provide that kind of credit. Not only that, this foreign exchange markets, which we call as forex market, will also help in hedging facilities, right? Now here comes the question, what is hedging, right? See, whenever you want to cover your risk in foreign trade, you use this technique called as hedging. Now, what happens in hedging is, hedging helps importers or exporters to protect themselves against the losses that happen because of changes or fluctuations in foreign markets. See, you have entered into a contract at one rate, but there are frequent foreign exchange fluctuations that are happening. There are frequent foreign exchange changes that are happening. You cannot take up so much of risk as an individual, or you cannot take up so much of risk as a institution. So you can use a hedging technique where you can have a control, or you can protect yourself against the losses of that frequent changing of what do you call as foreign exchanges in the foreign market. Not only that, there are certain instruments used in foreign exchange market. What are these instruments which are used in foreign exchange markets is, see, if you are talking about the spot market, in spot market, the instrument that is used is currency itself. I told you spot market is a market in which on the spot can transactions take place, or only cash transactions take place. This here, the currency is exchanged on the spot. If not, the second day immediately after the agreement is made, the currency is exchanged. It will not drag any more further, right? And these spot transactions are carried out over the counter. That is, they happen over interbank market, right? Where currencies are exchanged immediately. So in spot market, what is the instrument that is traded is, that is only the currency of the countries. But there, whenever you're talking about instruments in forwards market or instruments in derivatives market, we have different instruments that are used in derivatives market. For example, the first instrument that we use in derivative markets is foreign exchange forwards. See, whenever you want to buy and sell a particular currency of any country at an agreed date in the future and at an agreed price, today only you are deciding which country's currency you want to purchase at a future date, at a future rate. We call such kind of exchanges as forwards foreign exchange. The rate at which you are willing to buy, or the rate at which you are willing to sell, is called as forward rate. To put it in simple terms, whenever a buyer or seller agrees on a exchange rate which is pertaining to some future transaction on some particular date at some agreed price, we call such kind of contract as forwards contract. So usually the date is decided by both the parties, the duration is decided by both the parties, and the price is also agreed upon, right? We call such kind of transactions as forward contracts. Not only that, we have something called as currency futures also. See, what happens in futures contract is, in futures contract, one country's currency is exchanged for another at a specified date in the future at a future exchange rate. That is, the rate that is prevailing at that point of time, or the rate that would be existing at that point of time. You are taking that into consideration. We call it as futures currency. Now, whenever we are talking about futures currency, future currency can happen on two markets. One is exchange markets, that is, they duly happen on a what do you call as authorized stock markets or authorized stock exchanges. Whereas they can happen, whereas whenever we are talking about the forward contracts happen only on over the counter markets. See, Future contracts are settled on a day-to-day market basis, whereas whenever we are talking about forwards happen only over the counter. Not only that, the next instrument that we see in uh, derivatives market is currency swaps. See, whenever we are talking about currency swaps, they are also the over the counter derivatives. That is, they can happen only over the counter, not on the exchanges, and they are something which is related to interest rate swaps. See, whenever we are talking about foreign currency swap, it talks about the principal and interest payment in one currency are exchanged for principal and interest payment in another currency. I have to pay you something. Along with that principal amount, I have to pay you the interest also. So the principal and interest of one currency is buyed or sold or exchanged for principal and interest of other currency. We call it as currency swaps. This currency swaps are also the best examples to pay a fixed rupee interest, right, in floating charges. Not only that, we have something called as currency options also. What is currency options? See, currency option is an agreement in which a buyer or seller, right, between a buyer and seller, the buyer has the right to purchase currency for a specific amount at a predetermined date or rate for a specified time period. He is only given a right, but not an obligation. See, you are given a right that you can buy a specific currency at a specified rate for a specific time period. Whether you are operating it in the market, spot market, that is not taken into consideration. You are not obligated. It is not your duty that you have to definitely buy, but you have a right to buy. We call such kind of option as currency option. Now, whenever we are talking about currency option, the seller of the option, whoever is giving the option to the buyer, right, only gives him the right to purchase, sell, right, a designated instrument for a specific price and within specified time period. He can only exercise his right. The buyer does not have any kind of obligation to purchase. He is not forced to purchase, but he is given a right that if he wants to purchase, he can purchase. That option is called as currency option. Next, we have currency ETFs, electronic traded funds. Now, these are also one of the instruments that are used in derivatives market, or these are also one of the instruments that are used in foreign exchange market. Now, whenever we are talking about the currency ETFs, they purchase the currency of different countries based on calculated predictions. See, you will predict whether the exchange rates will fluctuate. You will predict whether the exchange rate will remain constant. Based on that, whenever you are what do you call as buying some traded funds, we call such kind of currencies as currency exchange traded funds. Now, next comes who are the participants in foreign exchange market. See, foreign exchange market is world's biggest market, and the biggest players in this foreign exchange markets are commercial banks or central banks. See, commercial banks play a very important role in this foreign exchange currency. Now, who are the participants of this foreign exchange currency is the first central bank. Central bank of any country. For example, if you are talking about India, RBI is a central bank, right? They play a very important role as they are the institutions, as they are the firms which possess the reserves of foreign exchange. Because they have the reserves of foreign exchange, they play a very important role. They regulate the foreign exchange rates, right, of a country's currency, right, to ensure fluctuations are within the limits, or they keep a control on the money supply in the market. See, if you ask who regulates money, who regulates foreign currency in our country, RBI has the apex body which has that power, which has that role to regulate things. So central banks play a very important role in regulating the foreign exchange currency. Not only that, we have something called as commercial banks. There are some designated banks, right, who have the power to exchange transactions in terms of foreign currency, right? Commercial banks facilitate international trade, right? They exchange with their customers foreign investments. So banks not only accept deposits from their customers, but also give loans and support them in terms of foreign exchange also. So commercial banks also have a very important role in, what do you call as, commercial bank is also one of the important participant in foreign exchange markets. Not only that, we have somebody called as brokers, who act as an intermediaries, or who act as a linkage between the dealers and investors, right? Now what the brokers do is they give you the advisory service about the best quotations. See, for example, if you approach a broker for help regarding the foreign exchange markets, they help you to get a better rate on the currency trade, right? They give you different quotes, right? These will help you to take the decisions accordingly. But they charge, I told you, they charge a minimum commission for the services that they render. So you have brokers who work for who act as interbank brokers, who have brokers called as client brokers. See, if you're dealing through banks, you can go for interbank brokers. If you're dealing it individually, you can go for a client brokers in order to get their expert service. Apart from brokers, we have somebody called as an investors or speculators. Now who are these? Is an investor or speculator is a person who purchases foreign currency, right, and sells it immediately between 2 points of time. He purchases and sells it so that he can get a quick profit from this purchase and sale. See, somebody who is looking out for high liquidity, because the market operates for 24 hours in a day. He buys during one time zone and sells during the other time zone, or he sells during one time zone and what do you call as buys during the other time zones, in order to make sure that he gets a quick profit. Such kind of people or such kind of individuals are called as speculators or investors. Apart from that, I told you there's somebody called as hedgers. These are the people who want to protect themselves from the loss because of future price fluctuations. So they enter into this foreign exchange markets, right, with the concept of hedging to cover its existing foreign exchange from future losses. Apart from that, we have something called as arbitrators. Now who are arbitrators is, they are the intermediaries who buy and sell the same currency in two different markets. Whenever there is a price discrepancy, they are multiple time zones, multiple markets which are operating simultaneously when it comes to foreign exchange markets. So what this arbitrators do is, they buy and sell the same currency in two different markets, right? Whenever there is a price change, or whenever there is a price fluctuation, right, or whenever there is a price discrepancy, they take the advantage of that price discrepancy and make sure that they exchange this currency for making profits. These are the participants of foreign exchange market. Now, whenever we are talking about foreign exchange markets, the first question comes is, how is this market structured, or who regulates this market? Because it is something to do with foreign currency, it is something to do with foreign exchange things. Who regulates the market, or how does the structure of the market works out is, see, the foreign exchange market, if you're talking about the Indian foreign exchange market, it operates under the central government. That is, government of India is officially designated to operate or control this foreign exchange market. Now the government will exercise certain specific powers, because they are working under something called as Foreign Exchange Market Management Act 1999, right? So these markets are regulated, right, by the central government. Now what happens is, they have a certain structured, this market comprises of certain things. See, for example, you can see central government is the body which is operating it, which is controlling it. It has given the powers to Reserve Bank of India in order to operate or control this market. So Reserve Bank of India regulates the foreign exchange market. That is, it buys and sells the foreign exchange so that it can stabilize this exchange rates or maintain them in a proper manner. Now, every action of a foreign exchange market or every activity in a foreign exchange market is completely regulated by Reserve Bank of India. Now, what does Reserve Bank of India do is they give something called as an authorized dealership. You call them as an AD, right? It is usually a commercial bank, right, which is authorized by Reserve Bank of India, right, to buy and sell the foreign exchanges. So if you want to be an authorized dealer, you have to get that authorized dealership from Reserve Bank of India in order to deal with foreign exchange currency. Now, how can you get this authorized dealership is, there are two categories. Category 1, known as uh, banks, right? Like commercial banks, private sector banks, public sector banks, and foreign banks. Category 2 comprises of regional rural banks and cooperative banks. Apart from that, financial institutions like Exim banks, that is exchange banks, right, come into category 3. So only these three banks, commercial banks, private banks, public sector banks, regional rural banks, cooperative banks, and Exim banks, these are the only banks who get the authorized dealership through what do you call as Reserve Bank of India to deal with foreign exchange reserves. Apart from that, we have something called as FEDAI. Now, what does FEDAI stands for is Foreign Exchange Dealers Association of India. Now, this is an association formed by all the ADs, all the commercial banks, private banks, public sector banks, regional rural banks, cooperative banks, and Exim banks form an association to make sure that these foreign exchange markets function very smoothly. For that purpose, they have established something called as Dealers Association. Now, apart from that, we have something called as authorized money changers. Now, what do these authorized money changers do is, it is a body which is licensed by Reserve Bank of India to deal with foreign exchange. Now, what do? They purchase foreign currency from residents and non-residents and sell foreign exchange to these parties. So these authorized money changers are the people, as the name itself indicates, money changer. They change one currency into another currency, but these are the corporate body which are licensed by Reserve Bank of India. Not only that, they can do it under full-fledged money charges. That is, they do it full-fledgedly, or they can be something called as restricted money charges, right? These restricted money charges are also permitted by Reserve Bank of India, right? They have been replaced by franchises, right? But now RMCs, that is restricted money charges, are no longer operating in the country. Apart from that, we have something called as a market maker, right? Usually a commercial bank which offers a two-way code, that is, they bid, they offer, they buy, they sell, right? Which is very, very important. So this is how the structure of foreign exchange market operates in India. This is all about foreign exchange market. Next comes derivative markets. Now, whenever we are talking about derivatives market, see, whenever you're talking about an investor or whenever you're talking about investments is all about buying and selling of assets so that you can earn some return on this buying and selling of assets or on these investments. So whenever you're talking about investments, people who invest in such kind of investments use different tools, right, in order to earn profits whenever they are investing. So when investors don't want to risk their position but want to increase the exposure to assets so that they can get more profits, they use something called as derivatives to reduce the risk, right? The market in which derivatives are traded is called as derivative markets. Derivative markets is also a financial market, right? It deals with instruments called as derivatives like futures, contracts, options. Now, it is very important. These markets are very important not only from investors' point of view, but for the overall country's economy also. Derivative market contributes a lot. So, from an individual's perspective or from a overall market perspective, it is very, very important to understand that these derivative markets play a very important role. Now, what is this derivatives that we are talking about is, see, derivatives are like any other financial instruments. See, whenever we are talking about derivatives, what usually derivatives do is, whenever we are talking about derivatives, derivatives are markets, derivatives are financial assets or contracts whose value is derived or whose value is extracted from the underlying assets. See, derivatives are also like any other contracts that you enter, but the contract as such does not have the value. Their values are determined or their values are derived from the underlying asset in which it deals with. Now, the underlying asset can be anything. The underlying asset can be like, it can be like metals, platinum, iron, gold, silver, zinc, anything. Or it can be energy resources like petroleum, electricity, crude oil, coal. Or it can be agricultural products like maize, coriander, coffee, rubber, pulses, spices, etc. Or it can be financial assets like equities, debentures, bonds, and currencies. So, whenever you are talking about a derivatives market, the contract and the underlying asset plays a very important role in determining the value of the contract. So you can deal with any of these metals or any of these resources, any of these agriculture products and financial assets as underlying assets in order to derive the value of the contract. Now, when derivatives have to be defined, or when derivatives have to be spoken about, see, any instrument which derives its value from other asset, or any contract which derives its value from the prices of underlying securities, we call such kind of contract, we call such kind of instruments, we call such kind of securities as derivatives. Now, whenever we are talking about derivatives, this derivatives helps the users to meet their demand by protecting them against the risk, right? Now, whenever we are talking about derivatives, derivatives are protected against the risk associated with the price fluctuations of the underlying asset. That is, they can hedge or they can protect themselves from fluctuations in interest rate, fluctuation in exchange rates, fluctuations in commodity prices, fluctuations in equity prices, right? They can protect themselves, they can hedge themselves against all these things. Now, there are two types of derivative markets, namely exchange traded derivatives and over the counter derivatives. Now, whenever you're talking about exchange rated derivatives, which are called as ETDs, they are central standardized. They are something which have a formal exchange with prices that are visible to all. See, whenever you're talking about exchange rated derivatives, their prices are known to everybody. They are formal exchanges which are done, right? They are standardized centrally. So they are exchange traded derivatives. Whereas whenever we are talking about over the counter derivatives, they are transacted laterally. That is, that exchange takes place between two parties depending upon their needs. So they don't have any fixed values, they don't have any fixed prices, they are decided based upon the mutual agreement of both the parties. Now, whenever we are talking about these derivatives, the derivatives market, right, has different types. You have something called as forex derivatives, which deals with foreign currencies. You have something called as equity derivatives, which deals with equity instruments. You have something called as commodity derivatives, which deal with commodities. And you have something called as interest rate derivatives, which deals with interest rate fluctuations. Now, what are the features of derivative market? How can you identify it separate from a foreign exchange market or any other market is, see, whenever we are talking about derivatives market, this is considered to be one of the huge market of traders from all over the world, because the volume and the traded value of the transactions is 13 to 15 times more than the regular markets. So you can imagine the size of these derivative markets. They operate on a very large scale basis. Now, whenever we are talking about the derivatives market, more than the exchange traded derivatives, over the counter, derivatives are traded most popularly, right? And whenever we are talking about derivative market provides better options for raising money. That is, they increase the depth in the market. They help you in easily raising the money in the market. So it is considered to be one of the most huge market. Not only that, they have a characteristic of leverage and gearing. That is, with a small initial investment of funds, right, you can get big deals or you can get big volumes in derivatives market. Not only that, these markets attract a large number of hedgers and speculators because they earn more profits with only lesser investments, because they exchange on the spot, or they take the benefit of two markets, or they take the benefits of two time zones. With lesser investment, they can earn more profits. Not only that, whenever we are talking about the derivatives market, the thorough understanding of the price behavior and product structure is very, very important. If you want to venture into a derivatives market, you should have a clear understanding, right, how a product is structured, or how a price is behaving. That understanding must be there. It's a prerequisite, it is a pre-qualifier if you want to enter into a derivatives market. Not only that, the derivative market has a low risk, right, because the products are standardized, or because the contracts are standardized through what do you call as stock exchanges. Now, whenever you're talking about derivatives market, they are more liquid. That is, you can convert them into cash very easily with low cost. And risk management, right? Short selling, you can sell it in very short period of span. Price discovery, and they're more liquid, right? These derivative market operate in a very efficient manner when you compare it with the other markets. Now, coming to the functions, what are the functions of derivative market? The functions of derivative market is, the first function is, the primary major function of derivatives market is risk management. It helps in transferring the risk, right, from one person, that is purchaser of the derivative contract, to the seller of derivative contract. See, what are you doing? You want to protect yourself from the risk, price rate fluctuations, interest rate fluctuations, currency exchange rate fluctuations. So you are trying to transfer your risk to somebody else. So the first major function of derivative market is to transfer the risk to somebody else. Not only that, it it talks about hedging. I told you, it is hedging is a mechanism which helps you to protect yourself, right, from the fluctuations that are happening in the market. So it helps in hedging. Not only that, derivatives market perform an important economic function called as price discovery, right? They are the markets which help you in measuring the future trends or speculating the future trends, so that you can discover new prices about the future markets. Not only that, derivatives market also help you in diversification. That is, instead of investing in one investment avenue, they give you a wide range of option for proper allocation, right? In order to increase or yield the investments, derivatives market will help you out. Not only that, the trading in derivatives market helps in augmenting of trading volume. That is, they help you in taking differential risk preference, right? They help the market participants to increase their trade volumes, which help in increasing the financial markets, or which helps in increasing the economic development of a country. Now, whenever we are talking about the participants in derivative markets, there are different participants in derivative markets. The first participants are investors. Investors are the people, or investors are the participants who enter the market with an objective to invest their money into the market and earn some financial returns, or want to earn some return on their investments. Second one is hedgers. Hedgers enter into this market to protect themselves against the price rate fluctuations. What they do is, they transfer or they mitigate the risk on somebody else. Next, you have speculators. Speculators are the participants who enter into the market with an intention to earn some quick profit by immediately selling it, or between two different time zones, or immediately exiting the market. Again, just like foreign exchange markets, you also have arbitrators here. What they do is, they take the advantage of making money by price mismatches that happen in two different markets. So these are all the participants of what you call as derivatives market. Now, when it comes to derivatives market, what are the instruments that are used in derivatives market is, the first instrument that is used in derivatives market is forwards. Forwards, futures, currencies, swaps, options, all these are the contracts that happen between two parties in which one party buys an asset and other party sells an asset, right? There is a minute or a difference between these two, between all these contracts. We will try to understand what it is. See, whenever we are talking about a forward contract, it is an agreement in which one party wants to buy and another party wants to sell an asset. It can be anything. It can be a financial asset, it can be a metal, it can be an energy resource, it can be an agriculture commodity product, anything. Now, what are they doing? They, on a predetermined date, they are determining it well in advance on a predetermined price. The price is also determined well in advance. When a buyer and a seller wants to buy and sell a asset, we call such kind of contracts as forward contracts. Now, what happens with forward contracts is, one party, right, is in a long position which agrees to purchase an asset at a certain predetermined, pre-specified future date at a predefined rate. And the other party of that contract is in a shorter position which agrees to sell the same asset on the same predetermined date and the same predetermined rate. The details pertaining to quality, quantity is negotiable mutually, and everything is entered into the contract. We call such kind of contracts as forward contracts, and they generally take over the counter products, something which has available over the counter, not in the stock exchanges. Those products are traded in forwards. Next comes futures. Whenever we are talking about futures, this is an agreement between two parties. Here also, one party is willing to buy the product and the other party is willing to sell the asset at a predetermined date in the future at a predetermined price. See, whenever we are talking about forwards, it is a tailored contract, whereas in futures, it is a standardized contract. They are traded on stock exchanges. They are designed to solve the problems in the stock exchanges. So the difference between futures and forwards is, forwards are traded in over the counter products, whereas futures are traded on the stock exchanges. But the price is predetermined, the time is predetermined in the forwards. The same is predetermined in the futures also, but there it is tailored, here it is standardized. Next comes options market. An option is also a contract or agreement which only gives the right to the buyer that if he wants, he can buy a particular financial instrument at a fixed price before or at a certain future date. See, for example, December 31st is the time period that is given, and there is a fixed price which is decided. I want to buy a debenture for 10,000 rupees before 31st December. I have a right to buy that debenture before 31st of August at 10,000 rupees, which is specified earlier. I only have a right. There is no obligation. So in option, you are given an option to buy. You have a right, but you don't have a what you call as an obligation, right? The buyer receives a right for which he pays something called as a premium, right? And the seller undertakes an obligation, right? Now, these options are traded in two styles. One is American style option and the European style option. In American style option, the holder can exercise the right anytime between the purchase date and expiry date. See, if I am a holder of a option, if I am a holder of an option, I can exercise my right anytime, right? On from the date of purchase to the date of expiry. See, today is 2nd of November. I have time till 31st of December, right? In between this time period, I can exercise my option anytime. Whereas in European style of option, it can be exercised only on the expiry date. That is 31st December only I can exercise my right. In between, I cannot exercise my right. That is called as European style option. Next one is swaps. Now, whenever we are talking about swaps is a agreement between two parties, right? Where they are trying to exchange, that is buy or sell one financial instrument for another financial instrument. See, I want to swap my product. Swap is nothing but exchanging. Swap is nothing but giving one thing and receiving the other thing. So when you're trying to exchange one financial instrument for the other financial instrument, we call such kind of agreement as swaps. They take place at a pre-specified time period, which is already mentioned in the contract. Now, whenever we are talking about swaps, there are two types of swap. One is currency swap and the second one is interest rate swap. Currency swap, as we all know, exchanging one country's currency for the other country's currency, which is predetermined, when which is already decided, that is called as currency swap. When you're talking about the interest rate swaps, when you're swapping the interest related to the same currency, right? Today, what is the interest? After 10 years, what is the interest? If you are exchanging this or we are swapping the interest rates, we call it as interest rate swaps. So, swaps usually deal with exchanging of currencies or exchanging of things. And the next thing is, who regulates this derivatives market? Derivatives market is again regulated by Reserve Bank of India, right? Because it is an apex body and most of the banks deal with this derivatives market. Reserve Bank of India is the apex body which regulates it. Apart from that, we have stock exchange, that is Securities Exchange Board of India, which regulates the derivatives market. And we have something called as Forward Markets Commission, right? The Finance Act 2015 has given rights to SEBI, Reserve Bank of India, and Foreign Markets Commission to exercise their rights in controlling the derivatives market in the country. Now, whenever we are talking about the derivatives market, there are some challenges that derivative market faces, right? We are talking it from a country's perspective, right? They see, whenever you're talking about derivatives market has a greater potential to develop, right? And is developing in the last few years. But the volume of trade and investments that are happening in derivatives market is increasing day by day, right? Throwing challenges towards the derivative market. So what are the challenges that derivatives market has is cash settlement versus physical settlement. See, only 1 to 5% of the country's overall commodity derivatives exchanges are done in physical delivery, right? This leads to inefficiencies in the current system, right? Which is very, very important. See, because distribution is the backbone of any product exchange, physical delivery is becoming difficult in the present day because of the volume of present day transaction that poses a greatest challenge to derivatives market. Not only that, stability and development is also one of the important challenge that the derivatives market is possessing. See, because it is rapidly growing and because of the huge number of transactions, derivative market is drawing an attention of regulators, right? Over the counter derivatives have been criticized because they lack transparency, because they are highly leveraged, right? Therefore, stability and development is missing in over the counter derivatives. The third thing is the warehousing and standardization. See, any country's commodities derivatives can run smoothly, right? When they have a proper warehousing system which is sophisticated, which is efficient, which is convenient, right? If these standardizations are not met, if they are not properly standardized, if quantity, quality, grading are not properly determined, you cannot trade in derivatives market. And not only that, lack of economies of scale. See, whenever we are talking about derivatives market, derivatives trading are permitted in more than 80 commodities, right? Whereas derivatives are only used for a few of them in practice. Theoretically, there are more than 80 derivatives that we can use, but only few are in practice. So only few exchanges are managing a lot of trade, whereas other exchanges are unable to manage those changes. So economies of scale is not possible in derivatives market because there is a lack of certain commodities which are not traded, which is also one of the biggest drawback with derivatives market. And one biggest challenge that the derivative market faces is the gray markets. See, these are the markets which operate or which exit outside the usual market structures. See, whenever you're talking about gray markets are unauthorized markets. Just like you call something called as black market, right? They're unauthorized. They are not illegal, but they are unauthorized. They don't have any legal restrictions upon them, right? Because there are no legal restrictions upon them, they operate it in their own style, thinking about their own profitability, right? This is a market where financial transactions or financial instruments or securities are sold and bought outside the trading channels. There is no over the counters, there is no stock exchanges, but they have their own markets, parallel markets running, right? Which are not monitored by SEBI, which are not monitored by brokers, which don't find place in any authorized manner. So this gray market securities, see, usually what happens in gray markets is the securities which are suspended from trading on the exchanges. Because see, whenever you want yourself to be traded on stock exchanges, there are a lot of legal formalities which have to be completed. There are very stringent norms that you need to fulfill if you want yourself to be traded on stock exchanges. So when a company fails to what do you call us when a company fails to follow or adhere to this strict normatures, they will be suspended from trading on the exchanges. So these suspended securities get an opportunity to be traded on the gray market. So there are popular gray markets. They have advantages, like issuing companies, startup company, investors and dealers go to these gray markets in order to raise capital, but they are not monitored, they are not supervised, they are not regulated by SEBI and brokers. So they are not authorized ones. We cannot call them illegal. At the same time, we cannot call them an authorized one. They operate by themselves. They operate by themselves. That's the reason it is called as a gray market. If you are a one-time investor, or if you are a new investor, or if you are a new issuing company, when you don't find a place for yourself in the stock exchanges, you will go to the gray market. So these gray markets are also turning out to be opportunities for investors. So it is very, very important to understand that these gray markets can pose a challenge to derivatives market if they are not regulated, or if they are not controlled by the SEBI, or they are not controlled by the stock exchanges. Yes, that's all for today. Thank you.
Thank you, madam.
Thank you. Thank you.
Thank you.